In this video, I am going to give away all of the secrets. We're going to talk about how an investor could have actually analyzed a stock that was during peak uncertainty and made an investment decision that would have led to a 5x return. Now, this is not all hypothetical or conjecture. This is a real case study. And what I'm telling you is things I actually wrote in live time and was thinking, because I do have an investment research company and I published a report on it in January 2023. It was over 160 pages. I spent well over a couple months researching it. And this is actually what I thought at the time. However, I also worked in the past at Goldman Sachs, and so I understood how to analyze a business, and I had a lot of contact with people in the hedge fund industry, and so understood how they would think about the stock as well. I also worked, and this is important for you to know, in terms of you judging my own legitimacy to talk on this subject, at a company that managed over $2 trillion in assets. Very often, they had positions in stocks that were well over $1 billion each, and that was actually a relatively small position for them. On analysis that I actually did, billions of dollars of capital did actually move. And so this is not just all a hypothetical, this is a real sort of investment case study. And what I'm also going to do is give you some of the story, the background, and the emotions involved in making these decisions, and not just the analysis, because I could give you the analysis, and that's kind of, you're going to look at it and say that's kind of obvious now. But I want you to understand how hard it was to come to these conclusions at the time. And so this is a little bit of a story of how you could have bought a stock that now everyone could have said it was super obvious in retrospect, but did it at a time when everyone would have doubted you and thought you were frankly an idiot for making these decisions, because it was obvious they were going to fail and never be the business they once were. That is at least what many of the bears were saying at the time. And it was reflected in the stock price that was down well over 75% at its max drawdown. Now let us begin and talk about how you could have made a 5x return on Meta. And so let us just set the background. So the year's 2019, Meta is, a low 20s, mid 20s multiple, it's still growing, high teens, low 20%. It's a pretty rosy picture for them. Not really a lot of fears around that. There's a little bit of noise that maybe the FTC wants to do something that hasn't really gained any momentum. Remember, Trump is still president at the time. And so, there wasn't just this big debate in the stock. It was really just a matter of how long they can continue to grow, but competition was not on people's minds. Then all of a sudden COVID hits and the stock draws down, a big drawdown to about $150 around its low. Now it seems like it is a pretty attractive investment if you thought they could return to their prior growth. But remember, at this time during peak COVID fears, people thought there was literally going to be a depression and this could be the end of economic growth for a very, very long time. This is not me making this up. I was sitting in the investment committee meetings where we were talking about how this could be like the 30s with another depression, maybe even worse because unemployment was actually higher than it was during the depression and it happened a lot quicker. Instead, what ended up happening was Powell was really quick to ease a lot of the monetary conditions. And so a lot of money flooded into the banking system. At the same time, the Treasury allowed for a lot of stimulus with these stimulus checks and also PPP, the loan forgiveness program. And so there was a lot of money flowing in and consumers actually ended up spending a lot of money and they couldn't spend it on travel. They couldn't spend it on food. So they spent it online. And this ended up being great for Meta's business. In 2021, they did $117 billion of revenue and were growing 37% year over year. At the same time, they had about $46 billion of operating income for the year. And so that was when the firm I was at continued to add to it when it did have that big drawdown. And then thereafter, if you remember, everything got crazy in the market. Meta didn't get quite as crazy in terms of valuation as some of these other stocks. At its peak, I believe it only traded at around 25 times earnings. That was a $360 stock price. And so that is where we're going to basically move on to the next chapter of this story, which is where everyone freaked out about Meta. Now, the story I'm going to tell you, though, is not that these fears should have been dismissed. It is that there was a lot going on at the time that was really scary. In fact, I identified 6 different things that were going on at the time that were really messing up, not Meta's price. We don't care about the stock price. We're talking about the actual business, things that could actually impact their earnings and ability to grow earnings over time. And so I'm going to talk about these 6 factors, and then we're going to get into some of the analysis of how you could have broken it down. Now, the first thing that was happening was TikTok competition. So for the first time ever, Mark Zuckerberg's talking about on the earnings calls how scary TikTok is, how much of a competitor they are, how they're, even if they're not directly taking time spent away, it's stopping them from growing time spent. And for the first time ever, they have a real formidable competitor, especially among the youth, much, much more popular. People at max are using TikTok 2 hours a day versus Instagram for maybe 40 minutes a day, Facebook for 20 to 30 minutes a day on average. So a crazy amount of time spent. And so that is the first thing. You have real competition, and people, despite using Facebook, Instagram, they have a general negative feeling towards it. And so there was this idea that if a competitor could come in and not just get all of this time spent from showing videos, which is what TikTok was, they could also potentially use the fact that people share a lot of TikToks with each other on the TikTok platform to kind of back into a social network. And if they were able to do that, then they could do stuff like stories, posts from friends, and then it becomes even more of a direct competitor to Instagram, Facebook. But even if it just stayed as this sort of video service, it was still soaping up a lot of time spent from what Instagram or Facebook could potentially do. And of course, they monetize time spent by showing ads, and so less time spent, less ads shown. That was the first thing going on. The second thing was kind of related to that. Mark Zuckerberg's response to this was to roll out Reels. Now, Reels at the time was not as good as TikTok, and it also didn't monetize very well because there's no ads they could really show against that because advertisers weren't making ads in that format for Instagram. And so as a result, what was happening at the time was their revenues were being cannibalized and Meta was cannibalizing themselves. So whereas in 2021, they were growing 37% with 117 billion in revenues, the following year, they only had 116 billion in revenues. Revenues actually were contracting. Part of that was because they're getting rid of the feed, which monetized very highly, in favor of Reels, which didn't monetize as well. And people were wondering, would Reels ever monetize that well? That was part of the debate. And if it didn't monetize as well, then you've permanently impaired their ability to generate revenue. So that was the second fear. The third fear was antitrust and regulation. People wanted to break up Facebook and Meta. This was when Lena Khan was really leading the push at the FTC to break the two up. It was unclear what would happen. Now, this one is a little different in terms of a risk because some people think that even if they were broken up, it could have been worth even more. My personal opinion is that if they were somehow forced to divest, well, one, it doesn't even make sense how you could do that because so much of the platform on the advertising side is integrated. And then maybe they would have agreements that they could share the advertising platform. And then if you did that, could they share the data? So it was very unclear how this could all work. But what was clear is that it's a distraction. And so as long as they had to spend a lot of resources fighting this, it just distracted them, right? And it also meant that they would be kind of tied from doing certain things like making other acquisitions or things that maybe were perceived to be anti-competitive, even if they weren't. Either way, it was a risk and it was something that was distracting management, taking up their energy. Now, the fourth thing, and this is actually one of the biggest ones, a lot of people kind of already forgot about this or never even knew about it, but it's called ATT, or App Tracking Transparency. Apple does not like Meta. Apple never liked Meta, and they did not like the fact that Meta was making a lot of money off of advertising and data. And so they rolled this privacy initiative out. Apple basically pretended at the time it's all about, privacy and making the consumer have more choice and all that. However, if you get into it, basically what it meant was that third-party apps would have to get approval to get the same level of data that Apple would automatically already take and advertise on. It was a little schemy in some of the way they advertised that, but business is business. And the result though for Meta was that they're basically going to get a lot less data signal because people did not want to share their data with Meta. And so people would get that prompt. They would say, no, I don't want to share my data with Meta. And as a result, Meta was not able to get data from Apple, basically. We're going to simplify this a little bit, but it's true enough that before, Apple would basically help send them data that would be collected on the platform with the user's consent. And you could have opted out of that, but by default, everyone was opted in. And so that's kind of what changed. And then as a result, now it's the opposite. You get this prompt, do you want to share your data? Everyone's going to click no. Apple's not going to share any data with Meta. And so Meta now all of a sudden had much less data signal. As a result, worse personalized ads. Worse personalized ads means that you're not going to be able to charge more for your ad prices. If you can't charge more for your ads, then that means you're going to monetize the ads even worse. And so that was the fourth thing that was going on. Also unclear at the time how that would be solved. And the fifth thing was the metaverse. They're spending 5 billion plus a quarter now on the metaverse. And so you had at the same time that revenues were shrinking, operating margins were shrinking too because you're getting worse operating leverage. And at the same time, the cash flows they were generating were going into this metaverse project that people did not have high hopes of because it's totally out of their core business, unclear how they're going to monetize it, and they just seem like they're burning a tremendous amount of money. The last piece of this too, though, was that CapEx intensity was going up. When we ran this analysis in January 2023, this was LTM, so last 12 months, it was 24% of revenues were going to CapEx versus depreciation and amortization being just 7% of revenues. And so what that means is that if they had to continue to spend this larger amount of money on CapEx year after year after year, depreciation would go up. That's going to be a headwind to earnings. That's if you're thinking of it on the P&L side. If you're thinking of on the cash flow side, then of course the CapEx is just a cash outflow. The other thing to keep in mind though is how much was growth CapEx versus how much was maintenance CapEx. And so that was everything going on at the time. People were freaked out about competition, freaked out about app tracking transparency, taking data away from Meta. They were freaked out about the fact that they're transitioning to Reels and Reels maybe wouldn't monetize as well. They're freaked out about antitrust and other potential privacy regulations coming into effect. And they were also freaked out that for some reason, Mark Zuckerberg's solution, and at this time, was to divert a lot of cash flows to the metaverse. All of that was happening at the time when the stock was basically melting down. And so the stock went from 360 to 250 to 200 to 160 to 180 to 140 to 130, which was when we wrote the research report. But that actually wasn't as low as it ever got. It got as low as $90 a share the following quarter. And so when we wrote this report in January 2023, it was basically one quarter before max pain in watching what happened with the business, because the following quarter, it was another terrible quarter basically. And so after that, though, they started to recover. So I just gave you a lot. There was a lot going on. Let us simply think about what is happening in this business. This was the analysis that I did. Now, I wrote a lot in the report, but it really can simplify to this. How does Meta make money? Let's think about it. There's 4 things that are involved in them making money. There are users. So how many users are on the platform? There's time spent. How much time does each user spend on the platform? There's ad load. How many ads can they show basically per minute or per session, however you want to think about it, to each user? And then the last one is ad price. How much can they charge for these ads? So you have these 4 different factors that ultimately is all the analysis came down to. Now, despite all the fears and talks of TikTok and people not liking Facebook, there was actually no signs that fewer people were on the platform. Users were continuing to climb. Now, they weren't climbing a lot. They're climbing 1%, 2%, but they weren't going down. That is really important. So despite everything you may have heard, you could just pull up their 10Q and see that the way they reported users, which at the time was daily active people and monthly active people, neither figure was actually going down. They were both flat to going up. And so users, not an issue. You don't need to think about that. The next one is time spent. This was a little harder to get comfortable with. Now, when I was at this asset management firm, we did have third-party data that went into different users' time sessions and all that. I'm going to be honest, it was not helpful at all to know that. If you do have access to third-party data, stuff like this, and I'm guessing most of you watching this video don't, you really didn't lose anything. In fact, the data was wrong so often that it was kind of useless. The provider we were using ended up getting sued for having wrong data. And so I think sometimes, especially if you're talking about a consumer business like this, it's pretty good. You could get a sense of it by talking to people that you just know, because everyone you know probably used Instagram, TikTok, Facebook, all that. And so talk across different age groups. You could do a survey. We did do a survey at that time to try to figure out what was actually happening. And the end result of it was that people were still using Instagram for about the same 40-ish minutes a day. And people are still using Instagram for about the same amount of time. It was just that instead they were also spending a lot of time on TikTok. And so if you think about this, and the thing I was kind of thinking about at the time was that the reason why you go to Instagram, it's different than the reason why you go to TikTok. So Instagram does one thing very well, and that is it connects you with your friends and family, and it shows you what's going on in their life because they do have that what is called social graph. And so that just basically means all your friends are on there, even celebrities, influencers, people you like. You have this content that you want to check in on. However, it's a relatively small portion of time spent. But it's kind of a main reason why you go on Instagram or Facebook in the first place is you just want to see if your friend posted something. And once you get through them, because it's not that many, it maybe takes you a minute, 2 minutes to go through your stories, your posts, and then that's it, right? The next thing that comes in though is suggested content. And that is what Meta was really focusing on, was their ability to suggest more content. And so my thinking at the time was that in terms of the social network, that sort of content where you see what your friend is doing, it wasn't really going to be threatened by TikTok. TikTok was trying to build the social graph, and they would do, smart things or schemy things, however you want to describe it, where if you did send someone to TikTok, it had a special customized link. When you clicked into it, it knew that who was clicking into it was a friend of yours, and it could suggest that you follow each other throughout the time that you're in TikTok. That was one way they tried to connect people through messaging in hopes that they could eventually build a sort of social graph. Never really worked out, but it was a fear at the time. And so you're looking at time spent. You know that it's roughly stable to flat. You know that Instagram does this one thing pretty well of suggesting friends content. And the thinking I had at the time was that as long as people click into Instagram and go to it at least once, a day basically, then Meta is going to have all these opportunities to improve the algorithm and catch them with more entertaining content, which will help not just keep time spent flat, but actually grow it. And so it was kind of like a little bit, despite the fact that TikTok was way ahead of them, they had this latent opportunity to catch up. And so that was my thinking on time spent. And so the other, though, big thing that was happening was they were giving you some data points with Reels that time spent was actually growing. And so even if you didn't have consumer surveys and none of that, you could have listened to just the earnings call and they were telling you that time spent was increasing as they were adding more videos on the platform. That makes sense, right? And so the first part, we talked about usage, not an issue. The numbers were there. It was flat to up. The second part, time spent, they're telling you right on the earnings call that it's actually increasing. Now we get to the third part, which is ad load. How many ads do they show? That variable really to me was not worrisome. Meta knows how to show people ads. They could turn that up as much as they want. It's just a matter of whether or not people are on the platform and how long they're on the platform. So that aspect of how many ads they could show them, you could have just assumed it was going to be flat. When you switch from the main feed, which has posts, to Reels, could it have been the same amount? I thought so. And so those first three variables, we kind of just very quickly negated. We said they're not going to really be an issue. Usage is flat to slightly up, time spent is up, and they won't have an issue showing people ads. So what is left? Ad price. How much are advertisers willing to pay for these ads? This is the most important factor. This is the one that took all of the research. And here's how you could have analyzed it at the time. One, you need to understand that when they do sell ads, it's an auction. And so the person that ends up winning that auction is the person who's willing to pay the most. How much they're willing to pay is going to be dictated by return on ad spend. And so every advertiser is basically willing to advertise as much as they possibly can, provided that they do get a good enough return on their money. Or you could think of that as a return on investment. So if they are spending $100, they usually want to see that they get at least $300 in sales. Usually though, it is much higher. Now that is going to ultimately be dictated by the gross profits of the product they're selling or service. If it's something like a subscription, then they can pay even more money for the ads because they think they're going to get a customer, maybe if not for life, for at least a couple years though. And there's a lot of recurring revenue associated with that. And so what you needed to look at was how the return on ad spend was trending. This was not an easy thing to track though. However, there was a lot of sources out there for you. You could have gone to Reddit. There's Reddit messaging boards where different advertisers talk about their advertising return. There's message boards where SMBs talk about how well Facebook is working for them. There's really actually a lot on the internet that you could track that could help you build some confidence. Though again, you also could just go right back to the earnings transcript, listening to the things they're saying. And they came out with something called Advantage Plus. Even before it actually was on the earnings call, they put out press releases talking about it. Basically, the reason why they're spending so much money on CapEx was they needed to repair the signal that was lost when Apple's app tracking transparency came into play. The way they did that was twofold. One, they put basically a lot of compute behind trying to better target ads with less data signal. And then secondarily, they came out with something called Cappy, which was basically an API that now advertisers would put onto the back end. And now when a user clicked into their site, instead of the signal kind of going through Apple, it would go server to server on the back end. And so Apple couldn't disrupt that. Because Facebook and Instagram were such an important channel to advertisers, they were willing to actually put this integration in to their website, which is, a little bit onerous otherwise. And so it was worth it for them to do that so they could still get these 10 million plus advertisers to advertise on their platform, which was necessary to get the sort of competition in ads to actually raise those ad prices and keep them high. And so the thinking that you could have done here is, as long as they're basically able to restore that signal or even improve it, then that meant that their ad revenues would be flat if it's just holding steady, or it'd grow. It would basically grow in line with how much they're able to improve it. And so again, on the earnings call transcript, they talked about the Advantage Plus suite, which is their suite of AI tools they rolled out for advertisers to help improve targeting and conversion. And that basically increased ad return. And they talked about how ad returns were going up. They also put out press releases saying the same thing. If you didn't want to take their word for it, you could have either tried to talk to someone in the industry to figure out what was going on with advertising. So many people advertise on Facebook and Instagram. It's not as hard as maybe you think it is, but there's also just a lot of great sources on the internet. We talked about Reddit. There's other message boards. There's also just a lot of information out there where people will talk about how Facebook and Instagram's working for them. You got to put together a lot of different antidotes to kind of figure this out. Now, personally, what I did is I did trust what Meta was saying when they published those statistics of how conversion was increasing. And in my thinking, this was only the beginning. They were just starting to spend money on all this CapEx, and within a couple quarters, they were already seeing improvements. And I thought over time, the data modeling would only get better. And so I actually had some confidence that this problem would be solved. This was, to me, in my opinion, the biggest overhang with Meta. I wasn't that worried about TikTok. I wasn't that worried about the transition to Reels. I had faith that Reels would monetize just as well as the feed. And that was because, in part, in 2012, when they rolled out Stories, people had these same fears at the exact same time that Stories wouldn't monetize as well as the feed and it would cannibalize it. It took a while, but then they started showing ads on Stories and they were able to get equivalent sort of ad pricing to that it's not actually cannibalistic. And so that's one of the reasons why, too, I like to look at a lot of history to try to see if there's anything I can learn from that. And so I wasn't worried about the transition to Reels. My opinion on antitrust was I also wasn't worried that they would actually be broken up. It just didn't really seem plausible to me. Not that I'm any sort of antitrust lawyers, but the people I did listen to and follow, it just didn't seem like they had such a great case at the time. And then, the ATT thing, I thought it would be solved and was in the process of being solved by the CAPI sort of back-end server to server and the new AI tools and their CapEx spend. And so once you get all of those big problems out of the way, then you're kind of trying to understand, okay, what does this actually look like as an investment? How much upside is there? How much downside is there? Despite the fact that I was comfortable with all these risks, I still fully allowed for the possibility that Apple could have done something else that could strangle the signal even more for Meta. I was also a little worried that maybe Google would want to do something similarly on their Android platform, which also would have been really bad. And so there were still risks out there. And another risk too at the time was that the EU was trying to basically make it illegal for you to show a personalized ad because they didn't really want you to personalize the ads at all without people opting in. And of course, most people are going to opt out. That's still an issue kind of going on right now. It's unclear how that was going to be resolved, but I thought, what if the same thing happened in the US and other markets? It wouldn't be good for them. And so there were still risks. I don't want you to think there weren't risks in that, despite my kind of understanding of the situation and what I thought the outcomes would be, it was still scary to invest in them because you had this company that was growing 30% plus. Now it's shrinking revenues. You have expenses skyrocketing. Margins were down about 10 points. And a lot of the excess cash flows were going into this metaverse thing. The metaverse at the time, I basically entirely wrote it off as saying that is going to be money they lost. They'll never recover. Did I actually believe that? I don't know. I did kind of think that they would never get a great return on it. Something would probably come out of it, but it's a call option was the way I thought about it. You needed to make the math work on the core business. And so this was kind of the qualitative analysis aspect of it. You might be a little surprised we haven't talked that much about numbers, but that's because the qualitative aspect is actually really important. And I would say more important because the numbers are kind of straightforward, to be honest. The way I kind of looked at it at the time was I did different scenarios. I wanted to see what the returns would be, what the cash flows and earnings would be, assuming that the CapEx they were spending wasn't just kind of one time, but it was actually continual CapEx that would be elevated and needed to actually keep this ad signal high. Because again, remember how I said D&A was 7% of revenues versus CapEx at 24? If they continue to spend CapEx at 24%, that basically means that D&A is going to go up 3 times, and that is going to be a huge headwind to earnings. And so I did different sensitivity analyses, assuming that D&A would eventually be 24% of revenue, which of course means that margins are now going to be 17% less. So I had one scenario where I was very punitive to what I thought margins would be. Then I also thought, what if growth was basically 0%? It was flat. All this money they're spending was just to stay where they are. It was all maintenance. And so I did that math and I plugged it into a reverse DCF, and I basically got the discount rate in that scenario to be around 9%. And so that may not seem like a great return, but the assumptions I'm assuming are very punitive. And so when we think about a margin of safety, it's the same thing as using very conservative assumptions. And so me using very conservative assumptions, like they'll never grow again and CapEx will be really elevated, was my margin of safety in that investment. I didn't actually think that they would grow 0%, but if they did, it could have still been an okay investment. That was the margin of safety aspect of it. Really important to understand that. It's not what I really thought would happen, but if it did happen, I would have been protected. I also did run the math on how much money I would lose if they did shrink revenues another 10%. 20%. Because again, this was kind of a scary time. And so when I did that analysis at the current, price they were trading at, which at the time I did this, which was $130 a share, there really wasn't a huge downside to that. Because if they did shrink revenues that much, in my opinion, they would have cut back expenses, just kind of harvested the business for cash flows. And that would have not been a great investment, but there was a little bit of downside in it there. And so the actual scenario analysis, it's all in that report I did, the reverse DCF and all that. Now, the upside to it though, was that if they could just grow 5% to 8%, then you could get 11 to 16% return. And I was kind of gearing a little towards that high on there. Now, what this return is, it's just the sheer mathematical output of running this discounted cash flow model, making the assumptions of revenue we talked about, plus margin we talked about, and then setting it all equal to that current stock price of $130 a share. And that is the return you basically get. So every one of these scenarios, I kept rerunning it and I would get that 11 to 16% return. Again, that's just mathematical, but it does assume over the entire lifetime of the business. And so you got to be comfortable making that assumption for that long. Now, there's other ways I like to look at it. I like to look at it on a more short-term basis too, which is just going out 3 years at the time, what cash flow multiple it would have been at. And my math was that if it grew 5 to 8%, it would have been about a 10 to 12 times cash flow multiple, assuming, some but not all of that CapEx was maintenance CapEx. And so if they were spending a good portion of that CapEx, it was to grow. And so if some of that CapEx is growth CapEx, then that of course means they're going to grow even beyond that 5 to 8% that I was assuming. And so that was another way I was looking at it. I could see going 3 years out, 10 times free cash flow multiple. And you could just say, okay, what is a fair free cash flow multiple for that business? At least 20, or you could just say, historical market multiple of 17 times, and you get that figure there. So that is another way you could kind of think about it. At the time, I also thought that if you go out a few years and assume low double-digit revenue growth and margins becoming a little bit more restored because they were kind of compressed at the time, but you still kept that metaverse expense layered in, I saw about $25 of EPS in 2025, somewhere around there. Maybe it would have been 23, 27. I, use a pretty big range because I want it to work in kind of either scenario. And so even if it was 23 and you put, a 20 times multiple on that, then that is a, $460 stock price. And so that was versus $130 at the time. And that's another way you could kind of think about it. So there were a lot of kind of easy math you could have done at the time. Once you stop freaking out about these things and you realize really what the real questions were, and hopefully you kind of understand how important the qualitative aspect is, because that is going to bleed into what is your margin assumption. Is the CapEx that they're spending, are they going to have to do it forever? Now, of course, I didn't know at the time they were going to jack CapEx up from 30 billion a year, which at the time was already 100% higher than prior year, to now, 70 plus billion to maybe 100 billion next year. I didn't know that. I also had no idea how much operating leverage they would show in the next couple years in 2024 and 25. That totally surprised me, if I'm being honest. If you remember, Mark Zuckerberg did the year of efficiency after that, and he had many quarters of 100% plus operating leverage because they were cutting expenses. And at the same time, all the CapEx they were spending was really leading to a lot better ad targeting. And so better ad pricing basically. And at the same time, Reels was working really well for them with time spent growing. And then, also threats of TikTok being banned to push more creators to Reels. And so that was another sort of tailwind for them. And so a lot of things went right for them at the time that, to be honest, I didn't see, but it didn't matter because I just needed to understand how I can make conservative assumptions with the margin of safety and see what the return would be. And if I could get comfortable with them growing 3% a year, which is all I had to assume to get a slightly above average market return, then that's great. And that's why I made that investment. I was not thinking this would be a 4 or 5 bagger at the time when it was at $130. I was thinking, okay, I can make really conservative assumptions, get a low double digit to mid-teens return. That was what my reverse DCF was showing. There's a couple other ways I was looking at the multiples. I saw maybe it's going to be a little bit better, but it was much better than I expected. And I think honestly, when you're right about an investment, that tends to be really common, that it is better than you expect. Because when you do buy a great business, you buy it on conservatism. You don't buy it on optimism. You buy it on kind of conservative variables, assumptions. And that's what I did at that time. And it was a very conservative way to look at the business. I did have some sense that yes, things could be better than I'm assuming, but why assume that? And so at least this is the way I would invest is I want to have high confidence in what I am investing in. And the best way to have high confidence in something is to have a large margin of safety. And a large margin of safety is the same thing as making your assumptions really conservative. If I could have made money if the stock was only growing 3%, then that's great. Of course, that's a much easier decision to make than me trying to decide whether or not Meta is going to grow 15% and if that's worth a 30% return. That's a hard thing to decide. Can they grow 15% a year? At that point, when everything was going on, that wasn't clear to me. Would a 30% potential return be worth that? I mean, that's a pretty good return, but the 15% a year, I don't know. That's a hard thing to sort of balance. And so I much prefer make the assumptions conservative. And so that was the analysis I did in January 2023 when I did buy Meta around that $130 stock price. And I did also, though, own Meta before when it was at $300 a share. And so at the time, I thought, wow, I just lost 2/3 of my investment, at least if you're looking at the price. And so it does add to making these decisions harder. But even those $300 purchases now, they weren't as great as the $130 purchases. It was still a fine investment to have a one bagger over a few years. When I bought those initial shares closer to $300 a share, did I have any idea all of these things that would come to Meta? Of course not. But I was in some sense too right at the time that a great company could survive all that. I had no idea the level of depth and damage and certainly not the drawdown. Of course, I wouldn't have bought it if I saw that coming, but there was still even some conservatism in that $300 stock price that still made it a decent investment, even though all of these things kind of happened that went against them for a few years. Now, things have went for them for the past couple of years. And so now it's a different sort of discussion today. But the reason why I wanted to focus on this investment in particular is because it was hard. It is very obvious now, but at the time, all of these different factors made it really hard to kind of see clearly and move all of the dark clouds away. And so that is why I wanted to kind of show you that any investment you're looking at, just simplify it to how does it actually make money and what are kind of the key risks involved in whether or not that is continuing or not. And so I hope you understood that with Meta, but if you want to understand better, and so I hope you understood that with Meta. In the future, I want to do more stock breakdowns. I do want to add more graphics into the videos, more numbers and all that. This for now is kind of the best I could do with me just talking at the camera without hopefully complicating it too much. But this was, again, a real investment decision I made, a real kind of analysis I was thinking at the time. Maybe you're surprised there wasn't sort of more numbers and analysis in it when we're talking, but in that research report I wrote, there was, that full reverse DCF. There was a lot more of that kind of laid out. But again, if I'm being honest, the reverse DCF came way after me understanding these qualitative things. And it was almost like something just holding my hand to make a decision that I kind of already knew a little bit beforehand because I could do that simple multiple math. And so that hopefully was helpful. If you have any questions or how to improve this, go ahead and drop them in the comments below. I want to do more formats like this, add in the graphics and everything. And so all of that will be on the way. But I did have this earlier video on how to actually research a stock from the beginning. And so check that out here. There's much more involved in the actual research process of the stock, the things you'll look at and all that. And if you want to learn more about investing, how to be a better investor and business person, go ahead and hit like and subscribe.